return concepts. And again, most of the material will be, or hopefully should be, familiar to you. Okay, so we'll talk about different kinds of return concepts, things like holding period return and so on. Get into the details of equity risk premium. You have seen the basics before, but we'll start with the basics and build on the basics. Then the required return on equity, and then a few brief comments on WACC and how do you select an appropriate discount rate. Okay, so when we talk about return concepts, I'm sure you remember the concept of holding period return. If you hold a stock for 6 months and the stock appreciates by from say 50 to 60 and there is no dividend, your holding period return is $10 or 20%. What's the difference between the expected holding period return and the realized? Expected is what you expect at the beginning, and then when you actually sell at the end, that's what you realize. What do we mean by the required return? The required return is the return that you require based on the level of risk that you are taking. Very simplistically, this is typically derived from a model such as CAPM, which is based on risk. Okay, so that's your required return. What's a discount rate? That's simply in your formulas, that's the rate at which you discount your future cash flows. There is a certain return that you get from the convergence of price to intrinsic value. What does this point mean? Let's say that a given stock is currently trading at 100 and you expect or you think that the intrinsic value is 120. Okay. Now, if the stock is trading at 100 and let's say that the required return given the level of risk is 10%, okay, then you are expecting two sources of return. One source of return is that regular 10% that you would get based on the level of riskiness, and the other is based on the convergence from 100 to 120. Once the rest of the world or the rest of the investment community realizes that the stock is undervalued, what will happen to the stock price? That will then go up. So that's one source of return. The other source is this regular 10%. And what's IRR? That's your internal rate of return that I'll again remind you of shortly. Okay, so now just a little more on each one of those concepts. Do you remember this formula for holding period return? It's your dividend during the holding period plus the price at which you expect to sell divided by P naught. So really basic. Okay, algebraically it can also be written as this. What's this yield called? That's the dividend yield, and this is the capital gains yield. If the dividend and the PH means how much you expect to sell it for at the end are realized, then the R is a realized return. If they are expected values, then R is the expected return. Okay. Required return is the minimum level of expected return that an investor requires in order to invest in the asset over a specific period given the asset's riskiness. We've already talked about that. This is just the formal definition. It represents the opportunity cost for investing in the asset, i.e. the highest level of expected return available somewhere else from investments of similar risk. Okay. Now, what's the valuation criteria? Some basic points. If the expected return is greater than the required return, then the asset is undervalued and you buy. Okay. These are assets that plot above the security market line, if you recall from level 1. If the expected return is less than the required return, then the asset is overvalued. And if they are equal, then the asset is fairly valued. Okay, now the concept of alpha that we didn't quite talk about in level 1. The expected alpha, which is also called ex ante, and this term ex ante and ex post are used frequently in the investment world. I don't know if this is strictly speaking correct, but the way I remember this is the ex is in both places. Ante, the way I look at it, is what do you anticipate? Okay, so ex ante refers to what you are anticipating or expecting. So the expected alpha is your expected return on a stock. Let's say that you expect a return of 12%, but given the beta of that stock, the required return is 10%. That means that the expected alpha is 2%. Okay, versus what's called a realized or ex post alpha. Anybody can have a high expected alpha. The real question is, what's the realized alpha? So you can brag about a realized alpha, you can't brag about expected alphas. So your realized alpha, also called ex post, and the way you can remember this is post the event or after the event, event being after you've sold and realized some return. That's the actual holding period return. So let's say your actual holding period return was 12% minus the contemporaneous required return. So this long-winded term is quite important. This is saying that over that same period, how did other stocks of similar risk perform? Okay, so if during that same period, other stocks of a similar risk gave a return of 14%, then your realized alpha is actually minus 2%. And there are several questions which go over this concept at the end of the reading. So contemporaneous return is the return on other investments with similar risk profile during the same holding period. The expected return and required return are often used interchangeably, but strictly speaking, this is not correct. Why? Because when can we say they are the same? They are the same if markets are efficient and all stocks are fairly valued. On the other hand, if you don't have an efficient market and some stocks are, let's say, undervalued. So if a stock is undervalued, then the expected return will be more than the required return. Okay. Expected returns from intrinsic value estimates. So let's say that a given stock is 25% undervalued. Does this mean that you will definitely make up that 25%? In the sense that, let's say a stock is 25% undervalued, can you be sure that you will make your return based on the riskiness of that stock plus this 25%? Not necessarily. Why? Because the mispricing may increase. Okay, you might believe there is a 25% mispricing, but let's say the rest of the investment community does not think so. Okay, then what will happen? It will become, from your perspective, even more mispriced. So will you have a positive return? No. The mispricing may stay the same. Sometimes mispricing stays in the market for a long time. Mispricing may partially correct, which will be good for you, or it may completely correct, which would be even better, or it may overcorrect. So the point is, just because there is a mispricing or a perceived mispricing, there is no guarantee that you will make money. Okay. Investors' expected rate of return has two components. One is the required return, and the other is the return from the convergence of price to the estimated intrinsic value. Okay, so let's just look at this example. Now you have been listening to me for a while. Let's see if you can do this problem. Yeah, so this is pretty straightforward. What are the two sources of return? One is the required return based on the riskiness is 7.6%. Okay. Plus what? Plus if this mispricing corrects. Okay, so that is the difference between the two, 71 minus 63 divided by 63. So if the mispricing goes away, then that's the return. Obviously there is a big if. What's the if? It's this: if this price were to converge exactly in 1 year, then your return over the year would be this amount. So this how much is this percent? So that's 12.4. So what's your total expected return? It's 7.6 plus. Yeah, but this is a 1 year period. So what's the holding period here? What's your expected holding period return? If the price were to converge in exactly 1 year, what would be the investor's holding period return? So if you currently have a price of 63, okay, so what you are expecting is a sort of a double barrel, or two good things happening. One is you are expecting, based on the riskiness of the stock, you are expecting that return of 7.6% over the 1 year period, and you are expecting this return also. So this is no the actually this is, as in, you can also refer, this is straight out of the curriculum. So the philosophy is this, and it's not really debatable, or it's not going to be debated right now. There is a 7.6% required return based on the stock, and they are saying this 60 research reports is intrinsic value is 71. Now I think the confusion here is this: according to the research report, the price should be 71 today. Okay, it's not saying that the price should be 71 in 1 year's time. The report is saying that this is underpriced, and the price today should be 71. So that mispricing will correct. That's this return. And look, if you read the words very carefully, at a time when P&G's market price was 61, a research report estimated the intrinsic value at this. Another practice question later will actually tell you that the expected price after 1 year is whatever. Okay, so there you would use a different logic. Okay, and if you have your curriculum in front of you, which I hope you do, you can actually look at this and don't make simple problems complicated. All you're doing here is the 7.6 based on the return plus the correction that you hope will happen. Now, what if so that's actually the working. And this is, I'm not making this up, I'm just using the curriculum numbers. If the investor expected the mispricing to disappear in 9 months, what would be the holding period return? So again, now the holding period is actually less than, so do it. No, the holding period return. So what do you think the holding period return will be? So what the mispricing is now, so 2 points here. Earlier the holding period was 1 year. What's the holding period now? So the holding period is less. Okay, so in a way, those who are saying more are correct if you annualize the holding period, but they are not asking you to annualize. What they are asking is, what is the holding period return? 18.1%. So the only time when returns are not annualized is when you are asked for a holding period return, and you are told that the holding period is 9 months. Okay, so if the mispricing is corrected in 9 months, the component of the return from the mispricing is 12.4%, but this 7.6% is your return over a year. So if that is the return over a year, the return over 9 months will be less. It will be 5 point something. So actually the exact answer is over, so let me just clean this up a little. So over the 9-month period, the return that you have is 1.076 to the power of 9 over 12 minus 1, which is about 6.65%, and the 12% stays the same. So your holding period return is 8%. I'm sorry, 18.05%. So those who are thinking that it should be a higher number are correct in the sense that if you annualize this, then it will be higher. But I think in both cases, some people were not carefully reading the question, which can hurt you. All right, so let's move on. And again, that just emphasizes, everything looked really simple, right? Till we just did a practice problem. So that's why I keep saying this, practice your problems. Okay, now, so actually what you just saw was not, was from the curriculum, but it wasn't one of those blue examples. Now we are doing a blue example. What you just saw was extracted from the text. Okay, now a formal, this is example number 1. I'll just, rather than spending time reading this, I'm just going to pull out the relevant data. So let's say we have this analyst, Thomas Veeramantri. Okay, sounds Sri Lankan. So he's looking at Microsoft. The current current price is 28.27. So the price is 28.27, and the relevant data is this. Over the coming 2 years, over the coming year, 2 more quarterly dividends of 0.1 are expected, and then dividends of 0.11. So what's the total dividend? 0.1 plus 0.1 plus 0.11 plus 0.11. So that's our total dividend. Now look, now they are telling you the 1 year target price is this. Okay, so do you notice the different wording here relative to the earlier example? So here you will actually say, okay, here there is not much ambiguity. So this target price accounts for both any mispricing and your gain because of the risk that you are taking. So an analyst's target price is the price at which the analyst believes the security would sell at a stated future point in time. So in case there was any confusion, they are clarifying that. Based only on the information given, answer the following questions. What is the analyst's 1 year expected return? For simplicity, now you can make this complicated, but for simplicity, just assume all this dividend is coming at the end. Okay, you can be more precise and use compounding and so on, but what they have done is just said this entire dividend comes at the end. Okay. Okay, so that is, so can you do this first part? Okay, so it would simply be the gain, which would be 32 minus 28.27 over 28.27 plus, that's the capital gain. What about this number? So this would be 0.42 over 28.27. So that's the dividend yield. How much is the dividend yield? How much? 1.48%. Okay, so let's say it's about 1.5%. So now how do we do the second question? What is the target price that is most consistent with Microsoft being fairly valued? Okay, to be fairly valued, you should get 9.5%. Now would that 9.5% include the dividend yield? Yeah, the 9.5% should include the dividend yield. So conceptually there are a couple of ways of doing it. What I think is simpler is, if the stock is properly priced, the question is, what is the appropriate target price? If the stock is currently fairly valued, let's say that this dividend yield of 1.5% you will get, okay, because there is less subjectivity there. That means what should the capital gain be? 7.5. No, this is 1.5, that's 9.5, so the capital gain should be 8%. So if the stock is properly priced, then the target price would be 28.27 into 1.08. Okay, so simple stuff, but requires some work. Make sure you go back and look at that example in the curriculum. Okay, next, discount rate. Discount rate is a general term for any rate used in finding the present value of a future cash flow. Okay, generally the discount rate depends on the characteristics of the investment. rather than the characteristics of the purchaser. Okay, so what I have basically done here is all these long segments in the curriculum, just taking out the core points that you really need to know. Okay, now I'm sure if you didn't know IRR, you won't be here, but still, very briefly. IRR is the discount rate that equates the present value of the asset's future cash flows to the asset's price. Okay, so you studied this in reading 6 in level 1. Okay, the simple present value valuation model or stable dividend growth. So this uses the IRR concept. So when we say that the price of a given stock is the present value of the future cash flows, assuming constant growth, what's the present value of a growing perpetuity? It's the payment over R minus G. So this is an application of IRR. So R is the discount rate that makes the present value of the future cash flow equal to your investment, which is what you are paying for the stock. If the intrinsic value equals the market price, we can calculate the required return. So if the market price if the market is efficient and the required return is the same as the expected return, then you can simply, with basic algebra, do what? You can simply then say R is equal to what? D1 over P plus G. You've seen this enough times. Why do we say this? This price is based on what? Or this R is actually an expected return or a required return? This is actually the expected return, because it is based on your expected dividend and your expected growth rate. So if you are trying to be very precise, you would call this an expected number. Anything that is based on expected things in the future, such as D1 is expected, G is expected, so this is a expected return. But if you recall from your, again, level 1, if the market is efficient, then the expected return is equal to the required return, and that's the point made here. If the intrinsic value equals the current market price, what is this saying basically? This is another way of saying that the market is efficient. In efficient market, the market price is the intrinsic value. So if that is the case, then this becomes the required return also. So if you look at finance textbooks, where you are calculating the required rate of return, sometimes you use this formula. What is the implicit assumption? Implicit assumption is that you have efficient markets. Okay. Next, so now section 3 of the curriculum, which is the equity risk premium. Now, you have definitely seen this before, but I think now at level 2, this is going to hit you with a lot more detail. So whether you like it or not, you will be thinking about stuff related to equity risk premium that maybe you hadn't considered before. Okay, so the equity risk premium is the incremental return that investors require for holding equities rather than the risk-free asset. So if you are investing in the market, let's say you are investing in the S&P 500, okay, obviously you will do that if your return on that is more than the return on a risk-free asset. That incremental return is called your equity risk premium. So that's reflected in this formula over here. Like required returns, equity risk premium depends strictly on expectations for the future, because the investor's returns depend only on the investment's future cash flow. So if you are investing in the market, let's say represented by the S&P 500, the risk premium or the equity risk premium, the return depends on expectations about the future. That's the core point. These points up to here are generally related to the overall equity market. Okay, so the proxy for this would be a index such as the S&P 500, or in Pakistan the KSE 100. What if we are talking about a specific share or a stock? Then the required return on a stock, there are two ways of looking at it. One is that the required return on a given share I is equal to the current expected risk-free rate plus a sensitivity factor called beta times the equity risk premium. This effectively is your CAPM. Okay. Another way of looking at it is to say that your required return is the risk-free rate plus an equity risk premium for that particular share, and there are many other ways of coming up with this. So conceptually similar. Here CAPM uses a beta times the equity risk premium. Here there is a equity risk premium that is specific to this stock. The question now is, obviously this equity risk premium is critical. How do we estimate this number? And broadly speaking, there are two ways. One is a historical method, where not surprisingly you look at historical information to come up with a equity risk premium, and another is a forward-looking approach. So we are going to get into the details of both. Okay. So let's first look at the historical. So these are historical estimates of the equity risk premium. So based on historical data, the equity risk premium is the difference between the broad-based equity market index return and government debt over some selected period. The philosophy or the thought is that if investors do not make systematic errors in forming expectations, then over the long run, the average return should be an unbiased estimate of what investors expect. So simplistically, what we are saying is, let's look at the last 20 years. Over the last 20 years, we look at the expected return, or the expected return on the equity market minus the risk-free rate, and then we take the average of all those numbers. That will give us the equity risk premium. Okay. The specification of the time period for measuring is important. I just picked 20 years. Now, should that be 20 years, 2 years, 50 years? Okay, now that's important. If we, generally speaking, if we use longer periods, the precision increases. Obviously, if we just use the last couple of years or 3 years since 2008 onwards, then what's the issue going to be? This short period included one of the biggest financial crises that we have seen. So to dilute the effect of that crisis, it makes sense to take a longer period. But does taking a longer period solve all our problems, or does it solve some problems and create some other problems? It creates some other problems. For example, do you remember a good friend called non-stationary data? Okay, when did that happen? When you have time series data, and if either the volatility changes or the mean changes, then your data is non-stationary, which creates a problem. So okay, conceptually it's better to go with longer time, but then that introduces the problem where the data might be non-stationary. Now with non-stationary data, if the volatility is changing, that's bad, but not that bad. What is really bad is if the mean is changing. So if your equity risk premium is changing over time, then that's a problem. So ideally you want to choose a time frame where you believe that the equity risk premium is not changing. And as a side remark on this, I would not get too, I would advise you not to get too hung up with the details, as long as you know the core points, or at least have a basic understanding of what I'm saying right now. That's fine. I really don't think, unless you really enjoy this material, it's not worth spending too much time on it. If you must spend time on it, then do it after the exam. Otherwise, it will just consume you. Okay. Now, empirical evidence points to non-constant return volatility. However, it would be a less serious impediment if the equity risk premium fluctuated around a central value as opposed to shifting to a completely different level. So the point here is that if we use 20-year data, and in the first 10 years equity risk premium is at 4, and then for the next 10 years it's just moved up to say 8, this is a major problem. On the other hand, if it is generally fluctuating around 6 and initially it's not too volatile, then it becomes more volatile, this is also non-stationary but not such a problem. Okay. Another issue is empirically the equity risk premium is counter-cyclic, which means that the premium is high during bad times. Why is the premium high during bad times? Because stocks are low, so the expected returns are high. That means the premium is high. And during good times, the stock price is high, so the expected returns are low. So there is some counter-cyclic nature. And then the challenge here, other challenges, that when a series of strong returns has increased enthusiasm for equities and historical mean equity risk premium estimates. So what does this mean? This means that over, let's say you are 1999, okay, so for the last number of years, the stock, market was just performing extremely well. So if the stock market has been performing extremely well, what happens to the equity risk premiums? So if you are using historical data, all the equity risk premiums are high, and those high numbers are pulling up the average. Okay, but if you are reaching the top of this bubble or the peak, where based on historical numbers, the equity risk premium now seems quite high, okay, but if you are sensible and you take the words of Alan Greenspan seriously, who at the time in early 2000s talked about this irrational exuberance, implying that, okay, the market is way overpriced. So at that state, let's say in 2000, the historical equity risk premiums were high. Why? Because if you look at the last few years' data, they were just pulling it up. But for a rational person, what is the expectation about the future? The equity risk premium in the future? That would be low. Why? Because you knew that a crash was coming, because the markets were way overvalued. So that's another challenge. Okay. Now, just interestingly, the curriculum sets this up and says that there are these issues and challenges, doesn't really give any solutions. And the answer, and that's because there are no clear solutions here. Okay, effectively what we need to know is that when we use historical numbers or historical estimates, there are these issues. The data can be non-stationary, and there is this challenge too. So as long as you know that there are issues, and as long as the issues that you need to be aware of are simply documented here, you, from an exam perspective, are in good shape. Okay, now in case you are wondering, there are two choices for measuring the equity risk premium. So we are still in the historical method. So if you are in the historical method, let's say that you decide to use the last 10 years worth of data. Okay, then you will have, for the last 10 years, for every year, there will be a equity risk premium, where you say that for the last 10 years, at the beginning of every year, you look at the expected return on the market and subtract the risk-free rate. So you will have 10 data points. What do you do with those? You need to take the average. Which average do you take? The geometric mean or the arithmetic mean? Has anybody ever thought about that? Okay, so that's a question, right? It doesn't have an obvious answer. Okay, but right now we are just setting up that that's a question. Another interesting question is, which risk-free rate do you use? Do you use the short-term T-bill rate, 3-month T-bill, 6-month T-bill, or do you use a longer-term government bond? A long-term government bond is also default risk-free. Okay, so which rate, are the two rates the same? Not necessarily, right? So in Pakistan they are similar because we have a flat yield curve, but that's not, if you have an upward sloping yield curve, then those rates are not the same. In the US currently, the short-term rates are practically zero, and the longer-term rates I think are like 2-3%. So there is a difference. So which one do you think we should use? Yeah, so again, so right now we are setting it up. Let's look at the first question now. The arithmetic mean versus the geometric mean. So what is the argument for using the arithmetic mean? So the two traditional arguments for the arithmetic mean, firstly, most, and here again I won't try to understand this too deep, as long as you just read these slides a few times and get a general idea, that's good enough. There is some statistical stuff underneath this which we don't really need to master. But there are two traditional arguments for using the arithmetic mean. One is that most major models are single period models, and if you are doing single period models, then use the arithmetic mean. And this one that most people will have trouble understanding, but just read it a few times. In case of serially uncorrelated returns and a known underlying arithmetic mean, the unbiased estimate of the expected terminal value is found by compounding forward at the arithmetic mean. So that's an argument. Don't worry too much about exactly what all this means. But in reality, the underlying arithmetic mean is not known, so that's against this. What you are supposed to use, or what is generally recommended, is the geometric mean. Why? Because present value models involving discounting over multiple periods, hence using the geometric mean is a better approach. So when you use present value, you are discounting future cash flows back. When you are discounting, it makes more sense to use a geometric mean. And another point, just as a given, geometric average does not introduce biases in estimating terminal value. So bottom line, whether or not you fully understood all this, the key is that in general, geometric mean is preferred. I really doubt that you'll be tested on this stuff, but what you might be asked in a multiple choice question is that in calculating the equity risk premium, is it better to use the geometric mean or the arithmetic mean or the harmonic mean or whatever? So the answer is geometric mean. And the other quick point in terms of the risk-free rate, let me read through this. Again, I'll just tell you the answer first though. It's better to use the long-term rate. Equity risk premium based on long-term treasury yields is smaller than that based on short-term yields. So this is more conservative. Why is this smaller based on the long-term yields? Yeah, generally the longer-term bonds will give you a higher yield. So the equity risk premium will be lower if you are using longer-term bonds. Industry practice tends to favor the use of long-term bond yields, even if you are using a one-period model such as CAPM. A practical principle is that for the purpose of valuation, the analyst should match the duration of the risk-free rate measure to the duration of the asset being valued. Does that make sense? So if your asset, if you are doing a long-term valuation, then your risk-free rate should be the long-term rate. Just as a side remark, advocates of using the short-term bond yield point to the fact that long-term bonds are subject to interest rate risk. So this is the argument for using short-term rates, but the arguments for long-term rates are generally stronger, and bottom line is use the long-term rate. Okay, the final point on the historical estimate, that you should, when you are using historical estimates, there will be some survivorship bias. Why? Because poorly performing or defunct companies are removed from the index. So the index inflates historical estimate of the equity risk premium. So if you're looking at from 2005 onwards, how has a given index performed? The fact is that a bunch of poor performing stocks have been removed from the index. So the index will have a survivorship bias, and hence the index return will be a little overstated. So inflates the historical estimate. Removing such biases would require a downward adjustment of the equity risk premium. Another point is a string of unexpectedly positive or negative events that do not balance out over the same period may provide the wrong estimate, which has to be adjusted. So when you are looking at the data, just try to make sure that we don't have a string of positive or negative events. If there are, then there needs to be some adjustment. Okay, this is a great example. Most of the things we've talked about, I think if you understand this example too from the curriculum, you'll be in good shape. I'll try and explain the example so you don't have to go through the whole reading, but nevertheless, if you want to read it, it will be good. So this is an India-based example. So the Bombay Stock Exchange 30 has a market cap weighted index of 30 leading companies. It's been compiled since 86, but the returns go back to 79. How is this possible? Is this logical? Yeah, so you started compiling it in 86, but let's say the 30 top companies that are in here, the index then was based on returns on companies. So the returns were starting in 1979. Okay. The backfilled returns from 79 to 85 are based on the initial 30 issues. So obviously the 30 stocks in this index had to be stocks that were around since 1979. Okay. So that means that stocks that were removed from the index in 1984, would they be in the index? No. So if you look at the returns between 79 to 85, would there be a survivorship bias? Yes. There would be a survivorship bias. Okay. Another point is that, and this actually is a point from level 1, but this is from a recent 2011 level 1. So those who did it before 2011 might not have studied this. So Sensex is a price index. A total return, so a price index is one where the index is based on the stock price. It does not factor in the dividend yield. Okay, so this index, if in a given year the stock prices remain flat, even though there was a 6% dividend, the index value stays the same. That is a simplistic way of describing a price index. How many people knew that? Okay, some of you, but now all of you know that a price index means that the index is based purely on stock prices, not based on dividends. The opposite of that is a total return index, which will factor in both the price as well as the dividend. So if you are really trying to look at what the return was, it makes sense to look at a total return version of the index. But anyway, Sensex is the one that we are studying here is a price index. Okay, another piece of information that most of you might know, the interest rates were suppressed prior to 1991. So till this time, the economy was pretty strongly managed, closed economy. And then the Indian economy started opening up in 1991. Post-regulation, the stock market volatility increased. Okay. Another thing that happened was the interest rates were low before 1991 because they were suppressed. Subsequent to 1991, stock market volatility went up and interest rates also went up. Okay. So that includes the risk-free rate. The risk-free rate went up after 1991. So now the questions are, what factors could bias an unadjusted historical ERP upwards? So the answers are right here actually. One is the survivorship bias. So because of that survivorship bias, there is the ERP estimate based on Sensex minus risk-free rate that would be higher than what it should be. The second point is the suppression of interest rates. So if interest rates were artificially low before 1991, what does that do to the ERP? That also increases the ERP because ERP is simply the market minus the risk-free rate. If the risk-free rate is artificially lower, then this number is higher. Okay, what factors would bias an unadjusted ERP downwards? Any ideas? Yeah, very good. So failure to incorporate the dividends would bias it downwards. So we would address that problem by using the a total return version, which only came into effect after 1997. Okay. So is there a question? Okay. State and explain two indicators that the historical series is non-stationary. So look at this. This problem captures in a practical way all the things that we were talking about. Why do you think this is? What is the data element we are after here? The enterprise risk premium. So what are the two pieces of information here that would lead you to believe that this data is non-stationary? Is high volatility?
It's like the cause.
If there is high volatility, does that mean it's non-stationary? Volatility changes, exactly. So the change in volatility. So in 1991, once the market started, economy was opened up a little, that's when the volatility changed. So high volatility doesn't mean non-stationary. The change in volatility means non-stationary. What else? Yeah, so if the risk-free rate initially was, I don't know the exact numbers in India, but let's say initially it was 4%, and then the risk-free rate then bumped up to an average of 8%. So and this is, let's say, the market returns. So the equity risk premium, the value fundamentally changed. Okay, so is that non-stationary? So during this time, the data is non-stationary. Okay, so just recognizing this is what you need to know. We don't need to say, okay, so what do we do about it? Okay, so we leave it at that.